Hi guys, and welcome to Macro Markets. This is Marcel Pechman, analyst at Cointelegraph and veteran stock markets and derivatives trader. Today is Friday, May 19th, and we'll be analyzing how the macroeconomic news and events impact the crypto space. Our first news from Markets Insider: the federal government's bank account just saw a sharp drop in cash as the default deadline looms. The Treasury general account had 87.4 billion on Monday, down from 140 billion on Friday. Treasury Secretary Janet Yellen reaffirmed this week that the government could run out of money as soon as June 1st. The Treasury general account is used to pay for debt service on government bonds, preventing the US from defaulting, among the myriad other outlays like federal employee salaries. On Tuesday, House Speaker Kevin McCarthy said it's possible to reach a debt deal by the end of the week. Okay, let's start by the funny part. The US is on the verge of debt crisis, which, according to Janet Yellen, would cause a financial catastrophe. And where's the sitting president? Traveling abroad. That says a lot about how concerned they really are. I'm not an expert on how the US Treasury handles their accounts, but my guess is they own other assets that can be exchanged for cash. Sure, they can't, according to the legislation, issue more debt, but that's certainly some accounting maneuver to exchange illiquid assets with the Federal Reserve or something similar. Again, that's just my own opinion. That's not Cointelegraph official view, so you can take it from my word. It's just my own opinion. However, we know the government is desperate to raise the debt limit because, ultimately, it means an additional $1.5 trillion in their pockets. The truth is, they have every incentive to show desperation and scare everyone off, so that the general public would pressure the Congress to approve the debt ceiling increase. But what about the stock market, gold, and Bitcoin? Well, no one can exclude the odds of a government shutdown and subsequent debt default, missing an interest payment over its debt. They're playing 4D chess with business, families, and the whole market. But who said they care about anything other than their own benefits? The problem is, how can one price a once-in-a-lifetime black swan, those unexpected events? Sure, Bitcoin maxis can say the collapse of the US dollar is a matter of time, and gold bugs would argue that the gold standard should be revived. But what happens on the very same day that the world realized that the emperor was naked and the precious US treasuries, the government bonds, are now worthless? You probably know the answer, but is afraid of having to calculate the impact on your portfolio. Yes, we're talking about a wave of bankruptcies and stock market crashes as people rush to liquidate their assets and get the most cash possible, preferably physical, at hands. In such a scenario, again, black swan, less than 1% odds in my opinion, Bitcoin could face a 40 to 80% drop in a couple of days. Remember, even the stablecoins rely on treasuries and the banking system, so there's really no way out of the risk completely. There's a catch here. After the dust settles and it becomes clear that the event completely changed the prospects for the stock market and real estate, why would investors keep huge cash positions? As soon as the government raises the debt and issues more money, they're instantly diluted. So if you're having cash at hand and the government issues another $3 trillion, that's an instant dilution. The money that you had in bank is now worth less. It doesn't matter if the inflation next 12 months is going to be 0, -10, plus 10%. The money that you had over the M2, the money that was in circulation, or the M0, which is the narrow definition money, you got diluted. Now you have a less portion of what's in circulation. That's when scarce alternative assets suddenly become interesting. Even more if the international remittance system, SWIFT, is suddenly compromised, or if major banks halt withdrawals, for example. For now, that's merely speculation, so I wouldn't fret too much. But as the deadline approaches, which seems to be early June, the risks increase exponentially. The key lesson: cash is king. During panic times, that's what people want. On to our next topic. Billionaire investor Stanley Druckenmiller warns of biggest and probably broadest asset bubble. Despite the Federal Reserve's aggressive rate hikes, Stanley doesn't believe the bubble has dissipated. Stanley also added, if we get a hard landing, there are going to be unbelievable opportunities. In other words, don't go all in. You can check his 1-hour conversation at the Sun 2023. It's available on YouTube, so the interview is really long. I only got a couple of the highlights from what I saw, but his alert is valid. For those unfamiliar, Druckenmiller is a former hedge fund manager. In 2010, he decided to close down his investment firm, Duquesne Capital, after 30 years of stellar performance. His fortune is over $5 billion, so he's definitely worth listening to. So when Stanley talks about hard landing, it means that the Federal Reserve will not be able to curb inflation slowly without killing the economy. That's what we call about hard landing. When the impacts on the economy are too hard, there's a big recession, or there's deflation, or there's something really odd about the economy. That's what's called hard landing as opposed to soft landing. So what is Stanley's main point? What his views different from the market? Well, he believes that what we're seeing right now in terms of unemployment, delinquency rates, and corporate earnings is completely masqueraded by the artificially low interest rates. Wait. So 5% interest rate is low? Well, it might sound high compared to the 0.6% average that we had for the previous 11 years, but that's exactly what caused the everything bubble, as he calls. Stanley is questioning whether 5% should have been the norm rather than the exception. Keep in mind that the billionaire investor never said sell everything and wait for capitulation, because experienced investors know that the bubble burst can take longer than expected, and asset prices tend to rise during periods of overheated economies such as the one we're living today. Now, on to our third and final topic of today's show. Let's talk about Walmart. Walmart raises full-year outlook as first quarter sales top expectations. The world's largest retailer reported first quarter same-store sales growth that beat expectation as consumers traded down from traditional supermarkets and slowed purchases of discretionary merchandise from rivals like Target. Walmart CEO said, "We continue to gain market share in the grocery sector, including with higher income and younger shoppers." Interesting point from the CEO, right? It's not that the consumer discretionary sector is doing extremely well, it's quite the opposite. What Walmart CEO said is that higher income consumers are moving away from more expensive stores and moving to low-cost retails such as Walmart. Moreover, the DoorDash and Uber Eats generation is being forced to microwave their own food. That's a big alert that was under the radar as investors focused exclusively on the positive outcome. Walmart raised earnings estimates. Yeah! The problem is the economy is fucked up. And what does that mean for Bitcoin and crypto investors? It should be initially concerning since the younger audience is extremely relevant for crypto demand. How can they pump frog coins and monkey NFTs if they have no spare money? As Druckenmiller said, be prepared for unbelievable opportunities ahead. Again, don't sell everything you own. We never know if the bubble is going to last another 6 months or 3 years. So meanwhile, the asset price will continue going up. So don't exit markets right now. Well, that's it for today. Remember to like and subscribe the new Cointelegraph Markets YouTube channel. See you.